Hello. The company being analyzed today is Capital Small Finance Bank. This, as the name suggests, is a bank. And today, we're going to cover this bank's financials. How is it looking? How is its growth looking? How is its credit health looking like? And so on. So, let's start. Now, first, we have a market cap of 1,296 crore rupees. Very small market cap. Current price of one share is 286 rupees. And the company is trading currently at a slight discount, that is slightly below its book value per share. So book value is the equity value or the net assets or assets minus liabilities. So book value per share 304 rupees, slightly higher than current price of one share. Return on equity 10.4 is decent, and this is actually a declining trend. Its return on equity has declined over the past few years, which is not the best look, to be honest. Return on capital employed to 7.04 is it's all right. It's all rightish. Not the best return on capital employed. Still above 7, but okay. And a dividend yield of 1.4%. So last year it paid around 1.4% of its current price. I guess 286 rupees as dividends. So 1.4% of 286 rupees, somewhere around that. Okay. Not the best return on capital employed, not the best return on equity, to be honest. Okay. Not bad, but obviously not the best. Then profit and loss, we got data from 2018 all the way to 2025. Okay, we got revenue, we got financing profit, we got the financing margin, we got other income, very important section. See, other income is a very important thing for banks. It adds a lot to profit. We got profit before tax. Here we got net profit finally. So in 2018, the company posted revenues of 271 crores, okay, and a negative financing profit, okay. In 2022, let's go all the way to 2022, 578 crores worth of sales or revenue for the company, 46 crores worth of operating profit, okay, financing profit, that's good, that's good. Then we go all the way to 2025, where we see 908 crores worth of sales or revenue for the company, 106 crores worth of operating profit, financing margin of 12%, really nice. 86 crores, you see 86 crores below 12%, 86 crores worth of other income, nice, giving us a profit before tax of 175 crores and a profit after tax of 132 crores for fiscal year 2025, gives out an earnings per share of 29 rupees. Diluted, does this earnings per share account for dilution? We don't know. So we can see that the profits and revenues have increased noticeably. In percentage terms, we only got for the last 5 years. But in percentage terms, the company has produced compounded sales growth of 15%, last 3 years, 16%, and TTM trailing 12 months of 14%. And the compounded profit growth over the last 5 years has been 39%, extremely high. Last 3 years, 28%, and TTM trailing 12 months or last 12 months, 20%. So the growth and profitability seems to have slowed down just a bit. I mean, noticeable slowdown, but still very fast growth in profitability. Even then, 20% massive for 12 months. Then return equity, it's a declining figure, which can be a concern, which can always be a concern. 12% 5 years ago, 3 years ago, 12%, last year, 10%. Okay, fine. So we saw good numbers, profitable bank, absolutely profitable, rising numbers. Now let's just see what the company is doing. Who does it give out loans to? So here we have the investor presentations of this bank, and we're going to analyze everything from here. Okay. So page 5 of this investor presentation, the latest one, here we see the growth of the bank. Now, it's a differentiated bank focused on middle income segment. Okay. Focus on the middle income segment. So let's dive deep, literally dive deep. Okay. Advances have grown Advances have grown from 1,148 crores in fiscal year 2016 all the way to 7,184 crores in fiscal year 2025. The total advances, like loans given out, okay? A CAGR of 23% in loans or advances. Really, really good. Then here you see 99.8%, 99.8% secured loans. See, secured loans, 99.8% secured loans, meaning backed by some kind of collateral, maybe a house, maybe some gold, maybe some other kind of property or some other kind of asset, backed by some other kind of asset. So if these kind of loans default, the bank, in theory, can take those assets, that collateral, now to reduce their losses. Okay. Average ticket size is 16.6 lakhs, and the loan book mix is across agriculture, mortgage, MSMEs, which is micro, small, and medium enterprises, and others. Then deposits have grown from 1,814 crores in fiscal year 2016 to 8,323 crores in fiscal year 2025. 18% CAGR, 18%, really, really nice. Now, these numbers you see in black, these are the quarter one fiscal year 2026, and these numbers in red are the fiscal year 2025. Currently, I think I want to focus, or we can focus on 2025 figures for now, just for now, at least here. Then profit after tax has grown by a 28% CAGR from 14 crores in fiscal year 2026 to 132 crores in fiscal year 2025. Very nice. 28% is massive. Now, the gross NPAs, the gross non-performing assets, like the percentage of total loans which have gone bad, percentage of total loans which borrowers are unable to pay back is currently 2.7%, and the net NPAs, which is gross NPAs minus the money set aside by the bank to cover these losses. So these are the final losses of the bank, you can say, is 1.4% of total loans. And these are some of the best numbers, I believe, in asset qualities among the small finance banks, okay? In that small finance bank segment, that sector that comes in. And customers have grown from 2.5 lakhs in fiscal year 2016 to 7.8 plus lakhs customers in fiscal year 2025. It's targeted towards middle income consumer, and credit cost is very low, ranging from 0.1 to 0.2%. Okay, fine, fine, fine. Let's zoom back. Let's just zoom a little back. Okay, let's just zoom a little back and continue onwards. Performance highlights? No performance highlights. So okay. Here, let's focus on a bit other numbers. We already looked at deposits and all. So return on assets is 1.2%. Latest number is 1.2% is the return on assets. NIM, net interest margin, 4.1%. Really solid. CASA, current account and savings accounts, as a percentage of total deposits, 35.9. Not bad. Higher CASA ratio is better because these have little interest payments to make. Like current account and savings account have low interest on them, okay? Low interest on these accounts. So it's better for the banks. And CRAR, capital adequacy ratio, 24.5, really solid. The minimum requirement is like, I think in India, 12%, and CRAR of 24.5, so really, really healthy. We already covered gross NPAs and all that. What else? We got 195 branches, okay, across 5 states and 2 union territories. Whoa, okay, you really nice. Okay, nice, nice, nice. We move on. What do we see here? Okay, this is for a fiscal year 2025. I think we have covered all of this. The ones we covered for here are for quarter one fiscal year 2026. Let's just move on. Let's just move on. Okay, asset portfolio. Fine, yes, it's loans. Who is it giving out its loans to? Let's see. All right, all right. So AUM, latest AUM, quarter one fiscal 2026, 7,437 crores. 30% of loans are agriculture loans, so given to the agriculture sector. 27% are mortgage loans. Okay. 22% is are MSME, so medium, small, and micro enterprise, or micro, small, and medium enterprises, trading and other business loans. So this seems to be the small business loans. Corporate loans, 14%. Okay, 7% is consumption other loans. So pretty diversified, seems pretty diversified. 30% agriculture, 27% mortgage, almost equal to agriculture, 22% nice one fifth from MSME trading, other business loans. We have corporate loans also, we have consumption loans also. Okay, all right. You already saw this. The ATS, average ticket size, the average size of loan is 16.6 lakh rupees. All right. What else? What else we have? Yes. Oh, sorry. The yield. Okay. The interest yield. What is the average interest yield on agriculture loans? So first you have agriculture loans, Kisan credit card, and agriculture term loans. Okay. 12.67% is the yield. So really high yield. The net NPAs are 2.18%. So agricultural loans seems to have the best yield, the highest yield, 12.67% yield on loans, and also the highest number amount of non-performing assets. Highest number amount of assets, number of loans going bad. So that's agricultural loans. Then we have mortgage loans. Okay. Mortgage loans seems to have the lowest number of non-performing assets, lowest number of loans becoming bad, and has an yield of 11.55%. Okay, interesting. Then we have these MSME trading and other loans, which have a net NPA of 1.58% and a yield of 10.7%. So, worst yield is these working capital loans, these MSME loans, and 1.58%. Okay. Then we have corporate loans. Corporate loans means loans to other NBFCs and loans to other microfinance institutions. Okay, NBFCs, which are non-MFI, and MFI are microfinance institutions. So loans to other financial institutions. NBFCs is the main one, 945 crores. Okay, in quarter one fiscal year 2025, I think it should be 2026. Okay, maybe I'm wrong. Who knows? Who knows? MFIs, okay, so the net NPAs is 14.135%. Wait, the net NPAs for microfinance institutions is a mind-boggling 14.35%. That is insane. That is awful. That is straight up awful. Microfinance institutions. Okay. But extremely low exposure, which is good, but still 14.35%. And the yield is given right here as a whole is 10.91%. Okay, so NBFCs, the NPAs, not NPAs are not given. Maybe this is a recent thing they started. Could be that. In a summary, agriculture term loans are the biggest ones in like gross advances. Average ticket size is 12 lakhs. Okay, average ticket size is 12 lakhs. Okay. NPAs are one of the higher ones, but the yield are also the higher ones. Loan against property, mortgage loans seem to be in the middle. The second highest, average ticket size 13.2 lakh rupees. The lowest not NPAs or non-performing assets, and the second best yield. Then we have machinery and like MSME loans, average ticket size of 23 lakhs, pretty big. Then we have NBFCs and all that. Okay, wow. Oh, sorry, there. Okay, sorry, I missed this completely. Consumption and other loans. Okay, consumption other loans, 529 crores were given out in advances. Average ticket size is 0.81 million rupees. I think that's 8.1 lakhs. Okay. We got this is NPAs. Very low. Oh, okay. So lowest NPAs are actually consumption loans. My fault. Consumption loans. This comprises of personal loan, auto loan, gold loan. Okay. 0.43% and a 9.75% yield. So lowest NPAs and also the lowest yield. So lowest yield is actually consumption loans, okay? Consumption and other loans, and the lowest NPAs are also from here. So it can be a trade-off. You get the lowest amount of non-performing assets, but you also get the lowest yield. Okay, fine. 9-10% plus secured, and their endeavor. They're trying to be a full suite banker for the customer, so covering all of the financial needs of the customer. Fine. This video is it's very slow. What else? Gross loan book has seen a 23% CAGR. Okay, nice, nice, nice. Again, emphasis on secured lending. 78% of loans are collateralized with some immovable property, with some FDR, fixed deposit FDR, okay, and gold. Oh, I think I've forgotten what FDR is. You can comment what is FDR down below. And gold, okay, 78%. Then diversified portfolio. These are the loans given out. So 30% of loans this latest quarter were agriculture loans. Then we see all the other numbers. Consumption loans, 7.1%. 26% mortgage loans. All right. Industry leading asset quality. Here you can see the gross NPAs and net NPAs. Pretty stable, actually pretty stable numbers. And it's seen as one of the best in the industry, which is good. Then we see the credit cost. I think this is the provisions made, the funds set aside to cover non-performing assets upon, I think, operating income. I think so, yeah, the operating income. 0.12%, 0.12%. A sharp rise in quarter one fiscal year 2026, mainly seen due to MFI, microfinance institution non-performing loans. So microfinance institution loans have become really, really bad, it seems like, and credit cost has thus risen. Okay, wow. Then, then, this is interesting. Okay, this is very important. Emphasis on collection and resolutions, even for sticky loans, close to zero write-offs and almost nil NPA sell-off. Okay, look at this. Look at this. These are the non-performing assets. Okay, these are the additions made for non-performing assets. So the new non-performing assets being added to the year, and this is upgradations and recovery. Recovery of loans means some amount of non-performing asset is actually recovered, and upgradation is kind of like that. The main gist is that you're getting your money back. You're getting some amount of money back. So you can see that, like in fiscal year 2023, there are 117 crores of already existing NPAs, and 154 crores NPAs were added, and 118.8 crores worth of loans were recovered or upgraded. So this much money was recovered. Write off. A write off is when a loan has gotten bad. The bank says the loan is unrecoverable. They can't recover it. So what do? They kind of just vanish it, make it vanish from the balance sheet and write it off as a loss. So it's taken away, it's removed from the balance sheet. That loan is removed from balance sheet and is treated as a loss in the profit and loss account. Look at these write-offs. These are absolutely negligible. 0.1 crores, zero point 0.3 crores, zero point 0.5 crores. Look at the additions, look at the upgradation recovery. 84 crores, 84.4 crores worth of additions of NPAs. New loans becoming bad were 84.4 crores in fiscal 2025. And and upgradations and recovery were 68.6 crores. So you can see that though closing NPAs have risen, non performing assets have risen, as the total number of loans have also risen a lot, you can see almost zero, very negligible write offs, which means the company is able to recover a lot of money, a lot of these non performing assets, a lot of these loans going bad. The company is able to actually recover a lot of the money, a lot of it. Then focus on secured products with strong underwriting capabilities, resulting in one of the lowest NPAs in the small finance market, basically, among the small finance banks. And they want to be a primary banker to the customers, having okay, better visibility of the borrower's cash flow. Okay, fine. But like really impressive, almost zero write-offs and NPA sell-off. NPA sell-off is like a selling off your non-performing assets to asset restructuring companies. You can sell these bad loans to asset restructuring companies and get some money, but they say they do almost zero of that. So they recover massive amounts of the non-performing assets. It's really impressive stuff here. Very important stuff here. Then the robust risk credit management. Again, we saw all these numbers. You can see this. A zero point 0.4 credit cost, only 0.4% credit cost in quarter one fiscal 2026. Negligible write-offs. Very, very nice. Very, very nice. We move on. Yes. Liability portfolio. Where are the funds? Where are the liabilities of the company coming from? Retail focused liability franchise with a high share of CASA. So total deposits, we already saw this 18% growth, CAGR. Here you can see the funding mix, where the company getting its funding from, positively skewed towards deposits. So you can see 82.3% of its total funding for the company came from deposits. So how is it, where is it getting the money from to make its loans? Of course, majority is coming from deposits, 82.3%. The red one deposits, 13.3% coming from shareholders' funds. So I believe the company's own, the shareholders' equity, all right, the retained earnings, all of that is contributing. Then other liabilities are a very small, what is that? 1.2%, and borrowings. Borrowings are 3.2%. So borrowings from other financial institutions, only 3.2% of total funding is done from that, and majority again from deposits. The cost of deposits is 5.9%. So I guess the average interest they have to pay on deposits to their, of course, the customers who made the deposits, and cost of funds is 6%. So the average, I guess, the interest they are paying on the funds they are taking from other financial institutions. What is this? Okay, deposits. Then what we see, they are trying to maintain a high CASA ratio, current account, savings account. Okay, focus. Okay, we have seen all this. We have seen all this. So what do we see here? Deposits and financials and key ratios of the company. Let's see. Profit after tax, you have seen this 28% CAGR. Latest quarter was only 7%. Interesting. Maybe they had to make more provisions. Yes, more provisions because the MFI situation looked so awful. So many bad loans there. Return on assets, we saw rising, actually a rising number. Interesting. Last 3 years at least rising from 1.2% 3 years ago to 1.4% return on assets. Cost to income ratio, a bit high, 62.3%. Not the best, not the worst. Okay, 62.3%. ICICI Bank has like 38%, the cost to income ratio. So, yeah, that shows how good ICICI Bank is. Um, yeah, yeah. Net interest margin, we saw that maintained at 4.1%. Really, really nice. Okay. Huh. All right. Then we have the statement of profit and loss. Now, here, I would like everyone to focus on, I guess, we can focus on a number of things. We can focus on a number of things. Let's focus on other income. Other income for banks is important because it includes like fees that they earn from like loans processing and all the things, credit cards, fees, and all that. It has increased. Oh, sorry. Yes, it has increased. Other income has increased from 54 crores in 2022 to 86 crores in 2025. And you can see provisions and contingencies. You see provisions and contingencies. This refers to the money set aside to cover bad loans and all that. Increased from 51 crores of provisions and contingencies were made in 2022. 54 crores were made in 2025. Not the most massive rise. You already saw they have almost like zero write-offs. They're able to recover a lot of the money. So that's good. Earnings per share. Let's look at diluted. Okay. Diluted earnings per share grown from 18 rupees in 2022 to 29 rupees last 3 years, pretty stagnant earnings per equity share. All right. Then return ratios. First, we have CD ratio. What is CD ratio? credit to deposit ratio. What amount of deposits are being actually given out as loans? Overall, we see a rising trend 70% 2022, now 81.4%. Usually, the higher it's seen as the better. There's a particular number, the sweet spot, but it seems to be increasing, I guess, which is a nice thing. It's giving out more and more of its deposits as loans. The yield on advances has also been increasing from 10.9% to 11.2%. So advances yield has increased, while cost of deposits have also increased slightly, 5% in 2022, 5.9. So both have increased. Then the cost to income ratio, stable. Last 3 years increase. That's not the best thing, but stable across last 4 years. Net interest margin, stable and currently on the high, 4.2%. Nice. The higher this number, the better. Non-interest income, what as a percentage? I'm not sure. Return on equity, this, the good days, 16.6%, 12%, now decrease all the way to 10.4%. That's not good. Return on equity being so low. Why am I inverted? Hold up, how am I inverted? Yes, yes, return on equity here below me, very, very low, really, really low. Yeah, that is a bad thing. That is actually not good. It is actually not good. What do we see? Okay, total other income, you can see the distribution. We have advances related fee income, which is the core fee income or the core fee income, operation related fee income. So the total other income was 23.4 crores for quarter one fiscal 2026. Out of this, we see the banker commission, which I don't know what that is, 9.5 crores, the biggest thing. They're given is at notes. Banker commission. Okay, okay. 7.2 crores worth of advance related fee income. Forex commission 0.8 crores, treasury income 0.9 crores. All right, all right, all right, all right. What we have here? We got borrowings, we got the balance sheet, bank's balance sheet. Okay, let's see. Book value per share. Book value per share has grown from 152 rupees per share from 2022 all the way to 296 rupees per share in fiscal year 2025. So nice growth in book value per share. Let's just move on. Let's just continue this. We are almost finished. Strategies and focus areas. Okay, what are the companies' focus? One, organic loan book growth and secured lending. Okay, it's targeting the existing segments only, as it says here, capitalizing on anticipated tailwinds, anticipated advantages coming up in middle income segments. They're elevating the liability franchise. Okay, they're expanding their brand outreach by opening up new branches. That's good. And they're strengthening profitability and operational metrics. Oh, fantastic, fantastic. They're trying to have an improvement in profitability and return on assets, and they're increasing their cost to deposit ratios on average basis to improve net interest margins. Pretty good, pretty good to me. Fine, we've seen all this. We have seen all of these. Finally, increasing presence. Where are they situated? So we got 195 branches in total and 164 in Punjab. Hold up, 164 in Punjab and 20 in Haryana. Very concentrated bank in terms of geography. Concentrated a lot in Punjab and Punjab alone. Then expansion plans. They're trying to transform Haryana into a growth frontier. Okay, all right, interesting. Yes, 21%. Okay, 40% of branches are in rural areas, but they account for only 21% of advances and 35% deposits. While urban areas, including metro, only have 23% of branches, but 45% of advances and 26% worth of deposits. While semi-urban areas have 36% of branches, 33% of advances, and 38.5% of deposits. Very interesting. Rural areas and urban seems to have an inverse Rural have more branches but lesser amount of advances, while urban have like the reverse thing, lesser number of branches and higher number of advances. The company has 189, 197, 197 ATMs. Finally, that's it. That's it. That was a long one. Okay. Stable return on assets, nice growth in other income, other fee income, and all that. Credit costs rose because of the microfinance institutions' really high non-performing assets. Almost zero write-offs, which is interesting to see. Uh, Good growth in both advances, good growth in deposits, rising credit to deposit ratio, which is, I guess, nice, leads to more growth. 99.8% of loans are secured, and that's it.